Rashesh Shah joins us, Chairman with the Edelweiss Group. Rashesh, good morning. Thank you for joining us, Rashesh. Everyone and anyone has applauded Friday's bold move by the government. But what is the next step? Do you think this bold move, even though it was cheered by India Inc. on social media, on Twitter, and by press conferences, may just not translate into reality and corporate India may secretly not start spending?
I would think so. I think what happened Friday, and actually not just Friday, what has been slowly inching up over the last 3-4 weeks, thanks to government interacting with the companies and investors and taking a lot of proactive measures, I think the sentiment is starting to change. And as we know, the market, ultimately we need three things. We need sentiment, we need liquidity, and we need the fundamentals. So I think the sentiment has started to change. Liquidity has improved, but we need to do more. So I would say the next important step will be RBI. The RBI October monetary policy is going to be an important one. I do hope that they cut rates aggressively. I do hope for about 50 basis points cut. And RBI through OMOs keeps on injecting liquidity in the market, because though there is liquidity, the credit markets are fairly choked and clogged, and we need to unclog them. So I think the government expanding from the fiscal policy and RBI expanding from the monetary policy, both combination could actually turn around, bring back the animal spirits and bring back investments and consumption back into the economy.
Soon do you think it will start? Rashesh, do you think it could take 6 months, 3 months, or FY20 will be a lost year? The real impact and the real on-ground activity will only start, let's say, somewhere in March, April next year.
I think it should start in the next 3 months. As I said, liquidity is now very key. Sentiment has clearly improved, and we can see that. I think it's not just the stock market movement, but I think even amongst companies and investors, there is a clear signal that government will do whatever it takes to make sure India growth story does not get hampered. Because what was happening last few months, India growth story was losing its sheen. Investors were saying, is India really a growth story? And I think what we have done over the last week is communicated to investors that India will go for growth, and if it means to loosen the fiscal purse, we will do that. If it means giving a lot of incentive for fresh manufacturing capacity, we will do that. So I think all of that, including the trade war going on, the new companies paying a lower tax is a big boost. I do think in the next 3 to 4 months, we'll start seeing activity and announcement. And as the mood changes, because also it's been almost a year of this slowdown. The last year's slowdown started from October onwards with the ILFS episode. So I do think, the base effect will also kick in. So I think post-December, things will start look even better, both from a YOY growth point of view, from numbers point of view, from activity point of view also.
What about investment, Rashesh? How do you see a pickup or a revival over there? The government clearly laying out the red carpet and hoping that this will lead both in terms of private sector capex, but also into bringing investment into India.
I think investments, it requires both sides, the corporate's willingness to invest, but also the availability of credit and liquidity from the banking system. For the last few years, because of the NPAs and all of that, banks did slow down their credit growth. In between, NBFCs had stepped it up, but even NBFCs for the last 1 year have slowed down and have not got liquidity for credit growth. So I think the willingness will come back, not only from Indian corporates, but actually more from FDI and foreign investors. And we're seeing a lot of interest from overseas to come and invest in India. But I think it will be also a function of the liquidity and credit flow availability. So we need to match both the demand for investment, but the supply of capital for investments also.
Rashesh, this is turning out to be one of those omega moments for equity markets as well. Do you think this is that re-rating moment? Just when you thought that the equity markets are down and out, this is what you needed to revive sentiment, and that's exactly what's playing out on the screen.
Absolutely. As I said, I think there was a complete swing of the pendulum from sentiment point of view. And we have always seen that, when anything is overdone, and I do think the gloom, doom, the pessimism was overdone. In my 30 years, I had not seen the kind of gloom doom that was being articulated in the last 3 months, media headlines, auto slowdown, all of that. So I think it was overdone. So the moment was also ripe, but the action of the government has to be commended, because they did go out and say that we will do whatever it takes. I think this was the whatever it takes moment for India growth story, and that has been the, I think, biggest change in sentiment, that people have revived confidence that India growth will eventually come back. It may not come back immediately, it may not come back in the next couple of months, but India growth story is not over, and we will do everything to make sure that the last 25 years growth story of India continues for the next 25 years.
Rashesh, where do you think currently tax was a challenge? When I say tax was a challenge, 10% tax which was acting as a serious problem in terms of getting that sector, business or that company efficient or cost effective.
See, in a way, it's not always one thing. So I don't think tax itself was a challenge, but what had happened last few years, if you look at the corporate profit as a percentage of GDP, has been falling consistently. In 2007-8, it was close to 8%. It has now gone down to 3%. So the corporate is surplus, because ultimately investments needs equity, also retained earnings. So retained earnings were drying up slowly and steadily. So I think this kind of a cut will give a lot more capital in the hands of the companies to invest. Along with that, I think, as I said, the psychological part and the sentiment part, that government is investment friendly, government wants to revive investments, government is willing to make compromises for that, is also been important. And we should commend the government, because after the budget, they quickly heard the industry, they quickly spoke with investors and realized that that we have to improve profitability, and a tax cut is one of the best ways to increase profitability. In fact, the government has not resorted to saying we will spend more money. What they have said is we'll put more money in the hands of corporates and allow them to invest. So even that is a good thing, because usually corporate investments can be more efficient and productive in the long term. Along with that, what is happening is all the other countries in Asia, like Vietnam and all, everybody, Indonesia, they have all been cutting corporate tax rate to invite more investments, especially with the trade war between China and US. If you cut tax rates, it also becomes a calling card for a lot of FDI and new investments to come in. So I think in a way, tax cut is a catalyst. It does allow more retained earnings. It will allow more FDI coming in.
Okay, Rashesh, really appreciate your time and glad you could join us. You've managed to scoot out of a board meeting to join us, so really appreciate that.